So, once again, good Saturday morning or whatever. It depends where you are in the world. Might be afternoon, might be evening. I don't know. Anyway, for me, Saturday is usual, and pretty quickly, I wanted to make a little bit of a follow-up to last week video. Promise, I'm not gonna talk about a lot of stuff like macro or fundamentals because I guess I just realized that that is a topic which is only good for nerds like I am. And I mean, for all the good reasons, because as I said, at the end of the day, your P&L, if you are trading, if you are investing, will be decided by price action. So I get people being a little bit more interested in how price is moving right here, right now. At the same time, I do realize that maybe people are not in for the long haul. Maybe people have a much shorter time horizon with their positions, and they don't really care about all the dynamics at play, but they just wanna know why price this or that. What do you think price is gonna do? Next days, next week, or what have you. So again, might have the same issues as last week. So mic levels a little bit off the chart, birds singing coming in, and what have you. But yeah, I never said I was a professional when it comes down to content creation. So that's what you have to deal with, assuming you want. So without further ado, as you know, as the real influencers say, let's dive into it. Now, let's start with the economic calendar for this past week. It wasn't really a huge week, especially if you focus on the US side of data release points. Yeah, I mean, of course, we had GDP, especially the second part of the week was the most important, maybe, with GDP, unemployment claims on Thursday, and then we got PCE on Friday and Michigan consumer confidence. So a little bit of news hitting the market, but even if you look at the actual results, as you can see, GDP pretty much came on in line with expectations. Wasn't really deviated from previous. It was 1.3% previous release, was 1.4 now, and as expected. Even PCE 0.1 as expected. Previously it was 0.3%. So again, this is a measurement tool which, as far as I'm concerned, it is particularly important for the Fed and for Jay Powell. It looks like they are not so obsessed with the pure CPI figures, but they are looking much more closely to these type of data right here. So you might say, oh, so it looks like it's coming down, so maybe it is good. Might be the final push toward actual rate cut. Maybe, maybe not. I mean, the thing I might grasp is that inflation is still on the path of coming down. Maybe it's not coming down so sharply as a lot of people were expecting, but still, it came back down. Now, there are two camps now. Those which are saying this is the new normal, so forget the 2% target, which, by the way, 2%, at this point, no one is able to come up for a reason, for a logical or mathematical reason why write the 2% target. It looks like it's arbitrary, but again, a lot of I think a lot of stuff with these center planners are sometimes are arbitrary, but anyway. And so this is the new normal. Get used to it. Higher bottom line inflation and therefore higher interest rates going forward. Maybe, maybe not. And there are the other camp which is saying, yeah, I mean, the huge deflationary spike is yet to come. We'll see. I'd like to have a crystal ball, but unfortunately, I don't have it. So, with that out of the way, let's actually take a look at some charts. And again, we start out with indices, US indices futures, again, same as last week, and Q, ES, and the Dow. Now, the week was relatively calm all things considered. We started out on Monday, and now I'm just pointing at the NQ because that's the asset I follow the most. But you can see that basically the other two, they are kind of reflecting the same type of dynamic, right? So Monday and well, really for Dow it was more on Tuesday, but initially starting the week out, we had this little bit of a drop, and it was completely reabsorbed. Then we consolidated a bit right here. And this, by the way, is a nice pattern. When you see something like a sharp move down, which is quickly faded and price gets stable back in the range, it's usually a good indication that you're going to trade higher. Now, it's easy for me to say here, no shit, Sherlock, because this is hindsight analysis, but this is just a recap after all. And what you see is basically price ramping up, finding a little bit of resistance at this prior apex right in here. Uh, Actually, if you look at it, it looks like NQ was a bit weaker than ES. I mean, ES actually really pushed into it, getting into this point of release right in here. The Dow, again, it looks like the weaker of the pack. But all things considered, you could classify this one as a consolidation type of week. If you zoom out on the daily time frame, you can see that basically all of them, they didn't move so much considering the week opened up in here, right? So yeah, I mean they NQ closed below the weekly open. Same for yes, and as for the Dow, again same. But we didn't breach these Monday's lows on, I guess, none of them. If not the Dow, yeah, the Dow actually it traded below, but it closed back up. So again, it's just a consolidation week. And I think, as we were saying last week, there are many things which were going around, getting into the end of the quarter, portfolio rebalancing, and a little bit of window dressing. So, if you're not familiar with the term, window dressing is when you try to make your balance sheet look a bit better, or at least being a bit more attractive, both for might be investors or, I guess, most importantly, the regulators. And there was this thing about stress tests performed on some of the few major U.S. banks. So again, these these institutions, plus the dealers and whatnot, they might have to actually move around their balance sheets when they come down into these expirations to, again, as the word suggests, window dressing to make them look, and I don't want to say better words, but to make them look as they would like people to perceive them, if you get what I mean. All right. So nothing major for indices. As I was saying, this is a period where you should expect naturally a little bit of a slowdown in markets and a little bit of a wishy-washy type of price action. If you want to use as best week these other type of layout and have a look at something like moving averages and indicators, you can see even in here, basically, we went up and it looks like on Friday we gave a lot of it back. Same for the NQ. But again, we are still above the 20-day simple moving average, and we didn't have either a massive breakout or breakdown. So consolidation is the name of the game. Now, consolidation at these high levels, when you see moving averages catching up, is usually a good sign. Okay, and at the same time, you see the overbought condition we were discussing last week being a little bit worked off. You can notice particularly well for the indicators like the stochastics. So you see the stochastics turning back down, going down, but price action is really not moving. Usually this is just as defined an indicator reset, and up until the point it can hold these previous area and price really can hold these lows, and maybe you're holding up above the moving average. This is still an uptrend, so nothing major. Same for the RSI, although there is this controversy now. I guess last week I talked about overbought conditions, and I was pointing at the RSI. Look, there are many ways you can use these indicators, right? There is no fixed rules, but I might say that if you wanna object that RSI is much better when you use it to spot divergences, and that should be the main use for RSI, totally agree. So if you misunderstood it, totally fine. I guess you're right. It was a good objection. RSI, even when I was using it, I wasn't particularly looking at overbought or oversold conditions, but what is really important is divergences. Those are the ones which offers up the best edge, if you want, or the best signal. Okay. Quickly looking at currency, as you can notice this week, I'm not including the BRICS or the Mexican peso or the Swiss franc. It was just one off because again, that is not something which I follow regularly. Yeah, from time to time, I have a look at them, but not really always. Uh, well, looking at the weekly, it looks like the Dixie had a decent month of June. One, two, three, four weekly green candles, so it looks like still going up. And conversely, you can expect the others to draw back a little bit and being a little bit weaker. Um, a little bit of a relief rally maybe compared to the the beginning of the month of June, but still, I wouldn't say the euro or the pound they closed pretty bad. So I wouldn't say it is really a rebound or a substantial bounce attempt for now. And bear in mind, this is a weekly time frame. Our dear poor friend, Japanese yen, and every time I look at it, I feel sorry for all these Japs out there on the other side of the world because this thing, it was fucked 2, 3, 4 months ago, and every time I look at it week by week, it looks always fucked and fucked beyond repair. Uh, I don't really have any other type of definition for it. I mean, I get it. It might be rude, might be insensitive, because these are dynamics which actually impact real people lives at the end of the day. So taking it so lightly, sometimes it might be like insensitive, but I also said last week that in markets, in financial markets, you don't really pay attention to moral of ethic, right? So again, look, this is just the way it is, all right? You can be the man going out in the world trying to change the world, and it's a very good, uh, noble, and probably rewarding endeavor, or you could be the man which takes things the way they are and just try to live and understand the world for what it is. And for now, the Japanese yen is fucked, so I'm gonna say it's fucked. Looking at the TLT, uh, well, we can say we had that type of a behavior we were kind of warning people of, and it was this one. I had it on the charts like this. No, this one, no, this is Bitcoin actually, but I should have it if I can find it back. It was in here. Let me check if I can find it back, because as you noticed, I really do it on the fly. I'm not putting in a lot of preparation. But yeah, this one. If you remember last week, I said this is a no trade zone because if you buy right in here, you take the chance of being squeezed out by the pullback. And at this point, it might be better if you wait for price to come back down in here and then you buy it, or you could wait for a retest, sorry, for a breakthrough, breakout from here, and then actually buying the retest. And I think it was this light right in here. Yeah. I highlighted this level as a potential buying opportunity, and this was around 91.60, I guess. And we traded to the actual low was 91.43, the close 91.80, rounding it up. So, I mean, at the end of the day, wasn't that far off, right? Now, again, not taking any credit. That is just to say that sometimes, you just want to be mindful of when and where you want to get into whatever market. And this doesn't mean that 100% we're gonna bounce from here. This just means that if you want to get in, this is one of the best places you can do it because you have a clear invalidation point, and it's crucial in trading and investing to be able to get in the closer you can to your invalidation point, because at this point you will minimize risk, maximize returns, or at least you're gonna really give the position room to breathe, which actually, even if it goes south, it's not gonna impact you a lot. So, you know, we're gonna see next week what's gonna happen. If it bounces up, it might take more than a week, maybe. If it keeps on trading like it did recently, we'll see. I mean, recently the moves up were particularly sharp, but I mean, I just watched a webinar on interest rates, and it looks like we are gonna have the something which is called the September effect. And even the author of the webinar, he wasn't particularly sure, or he wasn't able to find real and tangible evidence of why this is something which happens, and the mechanics and the plumbing behind it. But he just noticed that it looks like, based on seasonality, uh, end of August, September, beginning of October, you see some sort of a rally in yields, which of course there is an inverse correlation. So you might expect a little bit of weakness in bonds overall, but we'll see how it goes. Now, as for the rest of the bonds, it looks like they're still in this trading range. The one thing, people say, if you look at these charts at face value, right? And if you just look at them like this, you see that on this one you have a low and a lower low. On this one you have a low and a lower low. On this one, yeah, I mean you have the same kind of a low in here, then it goes for a lower low, and it gets particularly stable at these levels right in here. While, I mean, if you check my, if you can see my cursor on the chart, I'm not sure you can, but basically when I point in here, for the other two it would be here and essentially here. So you see that while the short durations are kind of putting in a low right here, the others are still going much lower than that. So people say, why wouldn't you buy the short duration? Well, I think I must say, first and foremost, that I'm not particularly good at math, right? Actually, math is one of my really weakest type of skill set, unfortunately. But I do know how to read. And so while researching around, reading around, I came across this concept of, first, duration, and secondly, convexity. So, this is particularly well explainable in these terms. Let's say, first, let's take a look at the actual lows for both of these three, for all of them. So let's say this is the low for the TLT, and I mean, of course, I'm not assuming that everyone will be able to catch the lows. This is just to express a concept, to look at the potential favorable price excursion in your favor. So from the lows to the most recent highs, you got what? A 22%, yeah, move. Now, if you go to the medium part of the curve, you take the same lows to the same ultimate highs before it completely drew back, and what you have is a 9.25%. And if you take the short duration from the absolute low, but I mean, for the sake of comparison, I'm gonna pick this one for both of them, for all of them. So October 2023, which it was right in here, price excursion in your favor would be just 2%. Now I might say, why is that? Well, this is just to disprove that no matter what you see in actual price behavior, the magnitude of the moves are different when you go down the duration curve. And again, these comes back down to duration risk and to the convexity of the bonds. So in simple terms, and again, uh, forgive me if I'm not first so highly educated in math, and secondly, if I can't really communicate that in English. But bear with me a little bit. At the end of the day, I'm a foreigner, okay? But anyway, let's take it to a very basic and simple concept. When you buy bonds, you're basically borrowing money, okay? Well, I mean, when you sell bonds, you're basically borrowing money. When you buy bonds, you're lending money. So what you need to realize is that the more duration increases, so the longer the period of the loan is stretched out into the future, the more you are exposed to duration risk. Think about it this way. If I lend you money for 6 months, right? I'm sure that in 6 months I'm going to have this money back with the interest rates which is set, and I can have the ability to deploy this money in other stuff, seeking better opportunities, better yields, right? But when I lend you money for 10 years, 20 years, 30 years into the future, I need to make sure that, this the positive spread, the yield that I'm collecting is rewarding enough to compensate me for the fact that I'm locking in this money with you and I won't be able to deploy them in other potential better opportunities that might come around in the next 30 years. So that there is this opportunity cost type of a discounting mechanism, right? So this is why, I mean, this is a very basic and core concept about why the farther you go down the duration curve, the more sensitive to interest rate fluctuations these assets are. So, the 30, the 20 years are going to be much more sensitive, and the 2 years, the 3 years, they're gonna be less sensitive. All right. And by the way, this is one of the reasons why I picked the TLT as a go-to when I decided that I wanted to deploy a little bit of capital into U.S. Treasuries. That was one of the reasons. Okay. Now, if you want to have a bit more of a complete explanation about duration and convexity, basically, because even convexity plays a huge role, because we tend to think about this inverse relationship in between the price of the underlying bond and the yield on it, so the interest rates which are tied to it. And we tend to believe that since there is this inverse relationship, this is a linear relationship. But as a matter of fact, it is not. It looks more like a curve, right? Which is why you call it convexity. And again, this is a measurement tool which is useful in assessing both risks and potential gains. So I'd say, I'm not going to take the risk of giving you misleading information, or informations which for me might be clear, but I take the chances of expressing them in a way which is not conducive or potentially misleading for you because I don't have the proper language skill. But I mean, you can just Google it. It doesn't really take a long to at least get around these concepts. And I found this video which is particularly good. It explains the formula. It gives you an example with an Excel spreadsheet, and and then it goes out in why we assume the linear relationship, while instead the relationship is not linear, but it looks a little bit more like a curve, right? So I mean, if you want to check that out, Ryan O'Connell, bond duration and bond convexity explained. Just 9 minutes video, and it gives you the ABC with actual math behind it, which unfortunately I'm not able to deliver. Okay, so that was it for bond. Not eventful. If you're bearish on bond, you might say all across the board it is a lower high and they're still bearish. Yeah, uh, I get it, but still, um, I'm sticking to it and I'm still in bonds, especially because I have two very good entries, and they are paying coupons, and the coupons are denominated in dollars, and I do live in Europe, so if I see my euro going down against the dollar and I can be paid in a currency which is appreciating against my own local currency. As I was saying, the dollar is a little bit misunderstood in the US, but for us, foreigners, there are many other considerations to be made. Okay, now quickly let's go to Bitcoin. If you remember, this was the chart that we had last week. Yeah, CME. I was using the CME futures, and I was saying, it looks like this could be a good area for a bounce. You have this previous space, the point of release, and all in all, it looks like if it is about to bounce, it's going to bounce from here. So, the point of the levels of invalidations were mainly these, but overall, I mean, even if it breaches it, yeah, you might say it starts to look bearish, but up until the point it can hold the range, and most importantly, the lows that were put in May, still not major concerns, and since it's a risk-on asset, it's relatively correlated to stocks and equities. So if you are particularly cool in assessing the downside risk on equities, you shouldn't be so worried about Bitcoin. Then instead, this is what we get. Oh, sorry, the brush. Okay, again, this brush. Go ahead. So we completely smashed through the levels, this one and this one. Eventually, we bounced right in here, but what you were expecting to be support has been bridged and now is acting as resistance, at least over these past few days. So this is ties in a little bit with what I was talking about when last week talking about bonds. I mean, is it a good trading area? Is it a no trading area? I guess, it is subjective a little bit. It's not up to me to decide for you. But what I would say is this is looking a bit like a trap fractal because now you are trapped from the previous deviation out of the range, which originate the actual move up. But at the same time, you're a bit trapped in the previous base, which is now flipped from expected support to resistance. There is a nice thing you could have done, of course, and this is just hindsight analysis. So this is bullshit. You don't have to take uh, a lot off of it. It's just to show how price moves and how price behaves, right? So start from the beginning. You see, we got this deviation off the range. It comes back in. Then we got another time a pick up in here, goes up, creates its tiny little fractal in here, and then from here you got a point of release which initiates a sharp move down into this lower fractal, and then from here is off for the races. And when it comes back down, you would expect this previous point of release which initiated the pickup to be support. You also have another point of release in here which really manifests the intentions of going up. So when this is retested, and it is this blue line right in here, which is particularly in line with both the flipped pour right in here and the origin of the move, the breakout point, whatever you want to call it. Now you can see this line when retested, it offers up a little bit of a reaction, but then it's completely crashed. And immediately you have a drawback into here, which is confirmed as support resistance flip, even in the short term, and it goes back down. Look this week, and this happened on Thursday, guys. Look where the weekly high for this week we just closed come in. Right at this level, once again. And this is just testimony that, you know, it was a very sensitive level. It was a very important level. And you can see how the interplays with it are actually manifesting themselves right now. So at the end of the day, even if you want to look at spot price action, which is kind of the same at the end of it, right? See the area, flip, but this point of release in here, hold it price once more. Now, I guess if you want to be bearish, I think you need to be short in here. But just for the support resistance flip dynamic. If you want to be bullish, you might have bought into here and now hoping for price to finally and actually reclaim these levels right here, even with a slow grind, but at least we're trying to reclaim it and moving upwards. Um, there is a nice, I mean, it's not nice in and of itself. It is just interesting because you hear these people saying, I mean, some people, not all the people, of course, but you hear people saying, you know what, you shouldn't really put on a position here because you could take the chance of price coming back up a little bit more before actually going up, sorry, down. Or, at the end of the day, this is just a reaccumulation, and up until the point these low, and particularly these lows of May hold, you shouldn't be bearish on this asset, and you should wait for these May lows to be breached before actually going short. Okay, look, from a structural standpoint, you're right, but when it comes down to execution, it is a whole different thing. I say, to me, let's think about things this way. If you're short in here, and if you are bearish, and if you think this low is going to be targeted, you want to be short in here. You put your stop, let's say, let's just assume you're not trading on leverage for whatever reason. So you put a stop above these highs, as saying I'm not expecting it to reclaim the just broken base. Okay, so some 3% type of stop, and you are aiming in here for an 8% down move. So all in all, this is what almost 3R on the short. Okay. Um, but people say no, you need to wait for the Malos to be broken, or at least for these one to be broken. Yeah, look, okay, but at that point, if you really want to go short the market when these lows are taken, look, it might be that eventually price goes down to where you think. The problem when major lows, swing highs like these are taken is that you always have some sort of a stitch up, some sort of a pullback, and sometimes it's particularly sharp. Now, it might be that all in all, eventually it comes back down. And remember, this is not me saying this is going to happen. This is me saying how would I approach a potential trade setup, okay? So this is not prediction. I'm not saying it's gonna go down. I'm just saying if you think or if your disposition of Bitcoin is that from here it's particularly weak and it's gonna come back down, I would be already short. If I was of that conviction and if I was trading Bitcoin first and foremost, I would be already short at this level. Okay, because the risk reward is there, and I don't want to short below the low because I don't want to suffer a potential squeeze and then, like the TLT last week, puking up in these guys the highs and then seeing it going. And this is just something that people do. They trade on they see the momentum and they don't realize that momentum usually is not the most optimal time to get in. You want to get in on pullbacks, not when price is impulsively breaking swing highs and lows. Okay, the market. There are two things which might happen. One I just described. The other one is you see the market going a little bit right in here. Okay, and maybe you actually short the breakout, or in this case the breakdown. What is going to happen is the market is going to go for a while and then eventually comes back up and you retest sharply the breakdown point. And if you don't know what you're doing, you might end up being stopped out at break even because you're scared. And this is just something which comes down to people which are trading basically their P&L instead of trading the market. But sometimes even the timing you have in getting into position, it helps you out a lot in actually manage them. So try to put yourself in a spot which is much more comfortable for you to get in from a risk reward standpoint, and especially try to put yourself into a spot where the trade management is going to be a bit easier for you. Now, I'm not arguing that the actual entry is a huge and key component of a trade, but if you're trading for something which is a little bit more oriented to swing trading, you're going to find out that the management is what really fuck people around, because you might get the best entry possible, but if you then mismanage a trade, you might end up, not realizing is actually coming back against you and you need to take your profits and run. You might not realize that this market is still room to go and you might close down the position and then you see it going for another 3 4%, you know. So the management is always, I guess, in my experience, because it happened to me, and sometimes it is still happening to me. I'm not saying I'm a saint. I'm not saying I'm a Paul to the Johns. It's just my personal experience. Managing trade sometimes is the hardest part. Okay, so try to stack the odds in your favor and to get in at the most favorable positions from the risk reward standpoint and from the future trade management standpoint. Okay, so this is it. Um, that's one. Oil, again, oil just keep on going higher this week. Um, we touched into, basically we filled in this inefficiency. We briefly almost touched this point of release on the daily time frame, but again, not seeing anything which suggests an immediate collapse. All right. If not, I guess one thing I have, I actually posted it the other day, and it was, yeah, it was about this one. Let's see if I can just real quick to give you kind of the bottom line of it. So if you're not familiar, don't want to turn it in an hourly long video, but these are break evens, inflation rate. There is a nice correlation they usually have with oil prices, and they started to go down on basically mid-April. And usually when they go down, it means that they are pricing in lower inflation down the road. Now, since oil is energy, and energy is the economy, and energy is reflected in any other thing we do in the economy, so if you got an energy spike, you're going to have a spike in inflation, of course. But what's interesting again is that they started to come back down mid-April, and from mid-April you can see oil came back down. They're still going down, but now you can see oil, they're still going down, right? But now oil just went up, so there is a divergence there. Now, usually these divergences, if you look back, they tend to resolve themselves in the favor of the break-evens. So bottom line is, it might see this pump in oil, it might be just short term, and you're gonna see it coming back lower. I'm not calling for new lows for now, but as I was saying last week, I think the fair value for oil should be around 77 as for this current moment in time. I also said you never know what it's gonna get because there is too many factors. Like now they're talking about, a further escalation in the war in the Middle East with Israel actually going uh, face to face with the Hezbollah. So again, it takes just a tiny little piece of news, and this market it just goes eye wire. So be careful with oil. Um, I maintain my stand that I don't really know, and really, I don't really even have some sort of a probability assessment for the short term. I think best case scenario is that it keeps on maybe grinding a little bit higher, but overall staying in this consolidation without any further type of sudden moves. But at a point, I don't know if that's what I think or just that's what I'm hoping for. So I need to be mindful and aware of my own desires and whether or not I'm trying to impose my views and my beliefs and my desires on charts. And so starting to see what I want to see instead of seeing what is actually there. Um, I'm putting a bit of faith in these break-evens divergence now, and I might say that might be over the summer we're going to see oil price trading a bit slower, so weakening a bit. Uh, who knows? We'll see. That's one. Gold to finish up. Gold, well, again, still in this trading range. You might argue we got the exhaustion phase right in here. We had the pullback, the reaccumulation. It went for a second test. It failed at new highs. It came back down sharply. It tried to reaccumulate and go for new highs once again. It came back down sharply. It tried again for the third time, and every single time it made a lower high. And these lows at this point, especially these bays right in here, it starts to be exhausted a little bit. So it might be that we see a drop in gold, maybe. Just, you know, I would like to remind you though that in here, and it was November 2023, right? We saw something similar. So look, we have the run up, pose, run up, okay? So we have the run up, little bit of a pose, run up, exhaustion, same as in here. Markets dropped, then it went for a secondary attempt at new highs right in here. It failed, same as here, right? Failed. Then it came back down to these lows, tried to reaccumulate it going higher, same as here. Came back down, tried, and again came back down, tried, failed. But what happened? When everyone was giving this market for weak, you suddenly have a pump like in here. So again, be careful calling it defeated or saying or starting to call for lower prices. Like I know people might say, yeah, you know what? I see gold trading back down to could be maybe to 2,200, maybe like something like this. A tiny drawback into here, very slow grind down. Mm, maybe, but given the macro circumstances right now, I wouldn't be so keen on shorting gold. Now, I do know there are people out there which maybe are kind of buying a little bit of a protection, which is a bit different than being actually short the asset. But say if you buy a put against your underlying holdings, so you actually hold the underlying and you buy a put, some puts against it, just to, some sort of an insurance policy on it, yeah, you might take the chance of losing a little bit of upside in case the put actually expires worthless, but at the same time you're locking in the profits that you have made so far. So pick your poison as any other thing. And with that, I'm gonna leave you off, and I'm gonna leave you off with a tiny little point on markets in general. Now, so far you have heard me talking about these 4, 5, maybe 6 charts, and I am, I guess you might say 80% of what we looked at, I was bullish, or at least I was like neutral slash bullish oriented. People who actually know me a little bit better, they do understand that although I might look at these charts and I'm bullish or moderately bullish, but definitely I'm not bearish. And people talking with me knows that I continuously talk about risks. So, geopolitical, China, Taiwan, and the US, Russia, Ukraine, Middle East. Energy, like oil spike, the economy is already too fucked to sustain another oil spike, so it could really trigger a recession, right? Um, Commercial real estate looming, commercial real estate crisis looming. And since, if you start to see commercial real estate going down, to the value of those buildings, you have actual loans which are attached to it, and those loans are held on the balance sheet of a few regional banks. So you might see another banking crisis 2.0 like we had in March last year. Again, I continuously have a look at all these potential risks. And when you actually start to look at news stream, it looks like no matter what direction you're looking at, it looks like the world is coming apart. It's like the end of the world is next week, but people just don't realize. I'm gonna tell you this because I guess it's gonna help a lot of people which are in the markets for the medium to long term. You might be worried for everything you can think of, okay? A little bit like I do. I try to stay in the loop, but at the end of the day, when I do trade, it doesn't matter what I read, okay? And it doesn't matter what I think. I mean, I'm I'm the most negative I think I've ever been in my life, especially after maybe it's my bad, especially after watching the debate in between Trump and Biden the other night. But no matter what I feel, no matter what I think, no matter my opinions, at the end of the day, price is the ultimate harbinger. And look, there is a simple explanation for it. All these negative factors, all these potential negative catalysts for a financial Armageddon, if I know it, and I know it because I read about them on CNBC, Wall Street Journal, or maybe I watched YouTubers talking about them. If I know them, if the newspapers know them, if the YouTubers know about these, you better be sure Wall Street knows about it. So it's already pricing in. It's already priced in, and the markets are not coming down. What really gets to market is more often than not, I say 90% of the times, is always an exogenous and unexpected event, which catch the market by surprise. Examples: nobody would have thought that the Fed would have forced uh, Bernstein and Lehman into bankruptcy. And at that point, the banking system woke up and said, "Oh, fucking hell! So can we actually fail? Can we actually go bust in here? Jay, stop everything, boys. We are not taking on more risk. We are not going to trade with any other counterparty, and we are not going to lend money to anyone." And the system just halted. And that's how, a real estate crisis became a global financial and monetary crisis. Okay? Or, 2020, about a virus. People are just calling a bad cold and whatnot. There are skepticism about it. uh, would you ever believe the government would have shut down the global economy and put everyone in their houses for like 4, 6 months? It was unprecedented. So those are the type of catalysts which really catch the market by surprise, and you see violent reprices when those type of events occurs. But look, this is not something which happens every day, right? And I guess it's just human nature to always try to picture the worst case scenario because, if I'm prepared for the worst case, if the worst case actually come to fruition, at least I'm prepared. And if it doesn't, well, it's all well and good. I was prepared anyway. So imagine how well off I will be. I was prepared for Armageddon, and we just have a rainy day. So I mean, I had food, I had guns, and I realized that everything I needed is actually an umbrella. I'm more than good, dude. But this is just human nature, I guess. So don't don't be so hung up on what the media are saying. Maybe this doesn't really makes me feel good, but I'm a huge content consumer, right? I watch a lot of stuff. I watch and listen to podcasts. I watch documentaries. I follow the news a little bit. And although I don't like it, sometimes I also indulge in following a little bit of politics. But that doesn't mean that when I do put on positions in financial markets, I'm thinking about all this stuff. All I'm thinking is a chart, a few indicators here and there, price behavior, and trying to assess probabilities of price moving in this direction compared to the other. Plus, I'm a very short-term trader, so I don't really give a shit, you know. But again, you need to separate the outside world from what the charts are actually talking about. There is an old saying which is it really goes like, show me the charts and I'll tell you the news. And I think it is another cliche which is gonna help you a lot in your experience in these financial markets. So again, I'm gonna cut the whole video here because it was supposed to be quick, but I've just noticed it's 15 minutes long. Well, cool. At least it's not an hour. I'm getting better at this, right? 10 minutes shorter. Yeah, okay. So again, have a good week. Gonna be a bit lazy later on this weekend. I'll see you all in the server, on Discord, in the chat, whatever, on Monday, presumably. Be cool, guys. Nils out.